my name's Anthony Kapitanovich and I'm the Managing Director of CollinsCo Wealth Management. Welcome to a new financial year. I'm joined by our Head of Investments, Chris Willaton. Chris, very volatile start to the new year, much of it created by the Greek crisis. Is it over?
I think there's still a long way to go in the Greek crisis. What's roiling markets at the moment are factors that have been around for quite some time. We've had things such as concern over Greece, which has been lingering for a few years. The tension has risen a lot more in the last 6 months with a new, an aggressive or assertive Greek government. And I think there's still a long way to go. As it stands at the moment, it seems as though a deal is close to being reached, but the deals still need to be ratified by respective parliaments in Greece, Germany and other Eurozone countries. So I think there's still a bit more water to go under the bridge yet. And once a deal's done, there's no guarantee that other things won't come out over the next 6 to 12 months. We've been saying for the last year or two that Greece can't stay in the Eurozone unless someone makes some pretty significant concessions. Germany doesn't seem prepared to do that, and Greece has now, it seems, made a lot of concessions. Whether it's enough for the rest of the world and whether it's enough to get the Greek economy back on its feet remains to be seen.
And Chris, there's two other factors that seem to be creating volatility: the Chinese market and the economy generally, like what is going on there, and also the US and US rates. They're still on the cards. What's happening with those two issues?
Well, they're the two flashpoints. There's a number of other domestic issues here in Australia, but just to address the points you've raised, the Chinese share market had grown significantly over the past year. In fact, it's still up 22% so far this year, but it did fall about a third from its highs in the months of over the months of June and the early part of July. So there's a lot of concern over the slowing Chinese economy. The rising Chinese share market is something that's been orchestrated by the government for various reasons, not the least of which is to create a wealth effect in the Chinese community and encourage some more consumer spending to rebalance their economy away from an export-driven economy to a consumer-driven economy. I think that the Chinese issue still got a long way to play out yet. I think their market still will go lower from here, notwithstanding a recent bounce, and I think the Chinese economy will continue to slow over the next 2 or 3 years. How much of an impact that has on Australia and the rest of the world is a point of great conjecture. And as for the US Federal Reserve, this is going to be the most telegraphed interest rate increase in history. They've been talking about it for 18 months. It seems likely now they will increase rates in September or December, but I think the US Fed could be the wild card over the next 6 months for markets, because if they keep pushing back this increase, then we might actually see markets rally on the prospect of lower rates for longer.
So Chris, we've just started the new financial year. How did share markets perform for the 14-15 financial year?
Well, it was a reasonably flat year in terms of overall growth in the share market. The total returns in the Australian share market, when you include dividends, were 5.9%. When you consider that dividends were about 4.5% of that, the actual growth was reasonably anemic. It was very much a case, though, of the haves and the have-nots. We had companies such as Macquarie Group, such as Ansell, put in some very strong performances. QBE also was a notable performer, and the theme there is that Australian companies with revenues outside of Australia, or considerable revenues outside of Australia, were some of the better performers. In terms of international share markets, Australians who hold investments outside of Australia did quite well in the last financial year, largely due to the falling Australian dollar. And the return for the global index in Australian dollar terms was about 23-24% last year. So it was a pretty reasonable year for those investing offshore.
Chris, just to finish off, you mentioned the Aussie dollar. I wouldn't mind getting your views on the Aussie dollar and also our housing market bubble.
Well, the Australian dollar is now down about 30% from its highs against the US dollar of, say, 2 to 3 years ago. And at around about 74 cents against the US dollar now, we think it is likely to go to the mid-60s over the next year. So there's still a lot of downside in the Australian dollar, which, as the Governor of the Reserve Bank's been calling for to help rebalance the economy, I think that's going to be good for some parts of the economy. Obviously makes things a little bit harder for those that want to travel overseas. But I think that's something that's almost inevitable, partly driven by, or largely driven by, a significant fall in commodity prices. We've seen the price of iron ore get as low as the mid-40s, say 43, 44 US dollars a tonne. It's recently been as high as 60 US dollars a tonne, but I think we'll see that slide back towards those lows over the next several months.
And the housing bubble?
Look, is there a housing bubble? I mean, we've seen significant growth in the Melbourne property market and the Sydney market. When you strip those two out, I think property prices have been flat, in fact, if not down around the country. Is there a housing bubble in Melbourne and Sydney? Well, property prices are very strong, but we are in a very low interest rate environment, and there are a couple of factors that are driving our property market higher. One is the fact that we've got a lot of international investors coming into the Australian property market. With the falling Australian dollar, that's even more of an incentive for them to do so. Another one is low interest rates are making it very attractive for property investors to borrow and invest in apartments in Sydney and suburban properties in Melbourne. I can't see a significant fall in Australian property prices unless we see unemployment go up quite a bit from these current levels, or we see interest rates go up. And I can tell you now, the interest rates won't be going up for a long time in Australia.
And for the next 6 months ahead, how do you think our share market will perform?
What we've seen over the past several weeks is, I think, a taste of the volatility that we will see over the next 6 months. I think the Federal Reserve in the US, if they do keep interest rates lower for longer, then I think that should spur markets higher. I am concerned about the impact of the volatility in the Chinese share market, though, and the slowing Chinese economy. And I think that will cause us more ructions over the next few months, and it could also lead to, and the slowing Chinese economy could also lead to lower prices in some of our resource companies over the next 6 months. But when you consider that the majors such as BHP and Rio have got very strong balance sheets, very low cost of production, those sorts of companies should hold up reasonably well, even in the volatility and low price environment that we foresee.
Well, thanks very much, Chris. Well, I hope you've enjoyed the first episode of CollinsCo Wealth Management's investment series. Until next time, see you then.